want to speak first?
Yes.
Good morning, everyone. We have gathered here to understand the different amendments that are applicable while writing the income tax subject for the intermediate exams scheduled for December of 2020. Now, the students would be writing the exams for November 2020, keeping in mind assessment year 2020-21. So it is assessment year 2021 that will be applicable to all of you when you are going to write the income tax intermediate exams. Uh, this particular assessment year of assessment year 2021 is slightly peculiar because usually when it comes to assessment years and income tax amendments that are applicable, usually it is one finance act that would be applicable to all of you. Okay, but this particular year, assessment year 2021, is a very special year, not because of corona, but because of several other reasons. Now, this is something that must have been told to you in a typical income tax class at Trisha, that the Income Tax Act is subject to changes with every annual budget. The budget speech is delivered by the finance minister in on the 1st of February of every calendar year. The budget speech proposes the changes in the income tax law for the upcoming previous year. And once the finance bill introduced in the budget speech is passed into an act called the Finance Act, the changes become applicable to the upcoming previous year. So if the budget speech is delivered, say on the 1st of February 2010, it would be applicable for the previous year 2010-11 and for the assessment year 2011-12. So when the students write the exams in May 2011 and November 2011, the changes introduced by the budget of 2010 on delivered on 1st February 2010 and passed into an act called Finance Act 2010, making necessary changes in the income tax, will be applicable. However, the year 2019 saw a lot of changes in the wind as far as India's economy, as far as India's finance, and as far as India's fiscal economics goes. First of all, there was an election in 2019, in the month of May 2019. So, because there was an election in May 2019, the budget that was presented on 1st February 2019 did make limited changes to the income tax law. Once the elections were over, a second budget was presented in the month of July 2019. The first budget on 1st of February 2019 was presented by the stand-in finance minister at that point in time, Piyush Goyal ji. And in the month of July 2019, it was the new finance minister that this government sworn in, Nirmala Sitharaman ji, who made the budget presentation. But the economy was tanking, and the government wanted to do something more to ensure that the businesses in the country are not affected by one of the worst depression that India's economy could ever see. So there were some ordinances and changes that were made in the month of August and September 2019 that would become applicable for previous year 2019-20 and would also therefore be and therefore for students writing exams in May and November 2020. After that, in the wake of Corona, some more changes were introduced in the last week of March of 2020. So therefore, students, while writing exams in November, December 2020, you have to keep in mind four different sets of amendments that have happened to the income tax law that would be applicable for assessment year 2020-21. These four different amendments therefore will be: the amendments introduced by Finance Act 2019, the amendments introduced by Finance Act number 2, 2019, the Taxation Law Ordinance of 2019, and then in the last week of March, you had got one more Taxation and Other Laws Ordinance of 2020. Now, this was dated 31st March 2020. If you had written the exams in May 2020, you wouldn't have to worry about the changes that were introduced in March 2020. Now, because the revision test paper that has been released, that has been made applicable for the exams to be held in November and December 2020, the revision test paper that was introduced talks about uh, changes that are applicable up to 30th April 2020. So normally the institute guideline says that 6 months before the date of your exam, whatever changes have taken place are applicable. So the revision test papers that have been released for the exams that you are going to write say that whatever changes that have been introduced up to 30th April 2020 would be applicable to the students. So keep in mind these four set of amendments that have happened to the income tax law, and this is what we would be talking about in the course of the next 1 to 1.5 hours. Okay, right. So I have made a small presentation on the amendments that are happening. I hope the viewers are able to see the screen. As has already been told to you, there are four set of amendments that have taken place. The Finance Act 2019, presented by the then Finance Minister Piyush Goyal on the 1st of February 2019 and passed into an act of the Parliament by both houses of Parliament. The Finance Act number 2 of 2019, presented in July 2019, talking about more amendments that were made to the Income Tax Act for the assessment year 2020-21. Then there was the Taxation Law Amendment Ordinance dated 20th September 2019. That would be applicable for assessment year 2021. And then you have the Taxation and Other Laws Ordinance of 2020, dated of all dates 31st March 2020. That is once again applicable to assessment year 2021. Now, students, please note, as you are intermediate students, the level of questions that will be asked would be quite low when one compares it to CA final students. So, though there are many amendments that have taken place, it is expected that the examiners will go a little easy on these amendments. Nonetheless, there are some significant amendments that you should know. There are some significant amendments that are applicable to your syllabus, the chapters that are covered in your study material that you need to know. So let's begin our discussion with the first part of it, Finance Act 2019. So Finance Act 2019 has made changes to the following sections, and I will also take you through the Finance Act 2019 itself so that you understand and appreciate these amendments better. So these are some of the sections that are applicable. Now remember, I'm only covering sections that are applicable to CA intermediate students. There are actually a number of more amendments that have happened through all of these acts, but I'm only talking about the amendments that are applicable to CA intermediate students. There are some very popular questions that are usually asked from different chapters for CA intermediate also. So let's start our discussion with Finance Act 2019, and the first section would be section 16. Now, section 16 talks about salary. Section 16 talks about the deductions that are available in computing income from salaries. 16.1, 16.3 talks about deduction for profession tax, and it is 16.2a which talks about the standard deduction which a salaried assessee is eligible for. This standard deduction was 40,000 available from gross salary till previous year 2018-19. With effect from previous year 1920 or assessment year 2020-21, this has been enhanced to 60,000. So here we go. Here's the Finance Act, and I would prefer to talk to you through the Finance Act itself. So here we go. The Section 16 has been amended with effect from 1st of April 2020 to make the statutory deduction or to increase the statutory deduction from 40,000 to 50,000. So whenever you are getting a problem on salary, please remember that the deduction available now is 50,000 under 16 1A. Yeah, it is 16 1A and not 2A. Under 16 1A, the deduction available would be 50,000 and not 40,000. This is very important because a question on salary is quite commonplace if you are a CA intermediate student. So be mindful of this particular point. Let's move on to the next section. Section 23 has been amended. Now, Section 22 to Section 27 of the Income Tax Act talks about the second head of income, which is income from salaries. Income from salary, I'm sorry, income from house property. Okay, the second head of income, income from house property. Now, income from house property, the calculation it would be something like this: gross annual value less municipal taxes paid will give you the net annual value. And from the net annual value, you get two deductions: 30% of the NAV and interest on housing loan before you calculate the income from house property. You will be told, or you were told during your class, that the NAV of a house property is zero if it satisfies certain conditions. The net annual value of a house property is zero if it is, number one, self-occupied by the SSE. Number two, is not self-occupied by the SSE because he is staying in another rented house in another place due to his employment or business. But more or less practically, we knew that if an SSE is self-occupying a house, the NAV of that house is zero. Section 23 further said that if an SSE acquires or if an SSE self-occupies more than one house, then the NAV of only one house can be zero and the other self-occupied house properties become deemed let out properties. That was the rule up to previous year 2018-19 or AY 1920, that the SSE can only opt for one of the self-occupied house property as zero NAV property, and the other house properties which is still self-occupying become deemed let out properties. To give you a very simple example, suppose I own two houses. In the first house, I reside along with my wife and children. And in the second house, my parents reside. I own both the houses. I'm not deriving a single rupee in terms of house rental from both the houses. Both of these houses I could not have claimed as self-occupied because the law said even if you are self-occupying two houses, at best you can treat one of them as self-occupied house and the other house becomes deemed let out property. Now, the valuation of deemed let out property has to be done, the GAV has to be calculated, the NAV has to be calculated, and some income from house property has to be offered to tax as far as the second house goes. But Finance Act 2019 now says the SSE now has an option to opt for two houses as self-occupied houses. So this is a landmark change in the income tax law because for a long period of time, for a number of years, it was always one house property that could be self-occupied. But from AY 2021, the SSE has an option to opt for two houses as self-occupied property. So in my previous example where I own two houses, where in one my family and in the other my parents are residing, in this example now from AY 2021, both the houses can be treated as SOPs or self-occupied property and the NAV from these properties can be treated as nil. Okay. Now a typical question at the CA intermediate exam would have been, before would have been, two house properties are given to you. The problem says both the house properties are self-occupied properties and the problem asks you to calculate the IHP in the hands of the SSE in such a manner that his total income from house property is less or his loss from house property is more. So you would have then option one, option two. So suppose there are house A and house B. Both are self-occupied by the SSE. In option A, you would treat house A as self-occupied, house B as deemed let out property, calculate the total IHP, and then in option B, you would treat house A as deemed let out property, house B as self-occupied, calculate the total income from house property, compare the two, whichever is less is what you will go with as the suggested option to the SSC. That would be an answer which will give you maximum marks in the exam. But now they have said that if there are two house properties, both of them can be treated as self-occupied properties. So I would think if there is a total income problem that is given to you, usually the first problem in income tax would be a problem that would ask you to calculate the total income. So if there's a TI problem that is given to you, there could be a chance wherein they mention that the SSE has two house properties. They mention the fair rental value, the standard rent, the municipal valuation of both the house properties. And they expressly mention that both these houses are self-occupied by the SSE or his family, or it does not derive any rent. Now, students, therefore, be careful. If such kind of a problem appears in your December exams, you are free, or you have to rather treat both the houses as self-occupied property, treat the income from house property as zero, give deduction for interest on housing loan. So this is something that you need to be aware of, that now two house properties can be treated as self-occupied property and the NAV treated as zero. The next amendment that has taken place in the Income Tax Act is the very next section, section 24. Section 24 spoke about deductions in calculating income from house property. There was municipal taxes paid and there was interest on housing loan that was deductible. Section 24 further states that now there was a limit subject to which interest on housing loan was deductible. If the property is let out, there is no limit. If the property is self-occupied, the limit is 30,000 rupees. However, if certain conditions are satisfied, the limit jumps to 2 lakh rupees. For a self-occupied property, therefore, the limit would have been 30,000 and in certain cases 2 lakh rupees. For example, if the loan is for purchase or construction of a house, the loan is taken after, if I remember correctly, 1/4/1999, and the construction completed within a period of 5 years from the end of the financial year when the loan is taken, then the enhanced deduction of 2 lakh is available. Otherwise, the deduction for interest on housing loan would be 30,000 as far as a self-occupied property goes. For a let-out property, the deduction does not have any limit. Interest on housing loan deduction does not have any limit. Now they are saying that as you can opt for two self-occupied properties, the deduction for interest on housing loan, however, would be limited to 2 lakh only. Okay. Observe here section 24 of the Income Tax Act, where they are now saying that the amounts of deduction would be now replaced by the aggregate amount of deduction, which means the amount of deduction that was available to a self-occupied property would now be replaced by the aggregate amount of deduction available to two self-occupied properties, which would be restricted to 2 lakh only. This is once again a very significant amendment. There could be problems where they are giving two house properties, both of them self-occupied, both of them having interest on housing loan. Say house A has an interest on housing of 1 lakh 50, house B has an interest on housing loan of 1 lakh 40. Both of them add up to 2 lakh 90,000, but the maximum deduction available or the maximum loss from house property that you can use to set off against other heads of income is 2 lakh only. So that is an amendment introduced by Finance Act 2019. We then move on to the amendment done to income from capital gain, section 54 of the Income Tax Act. Now, section 54 talks about exemptions from capital gains. Okay. Section 54 talks about cases wherein you sell a residential house, you buy a residential house. With the purchase of the new residential house, the capital gains on the sale of the previous residential house can be exempted from. Okay. Now, the provisions of section 54 was quite simple. You sell a house, you make a capital gain out of it. If the entire capital gain is invested in a new residential house, either by way of purchase or construction of the new residential house, then the capital gain is exempt to the extent of the cost of the new house. They had previously, around 3 years back, made amendments to mention that the purchase or the construction of the residential house should be only one residential house, that too the house should be situated in India. Okay, so when you sell a residential house, you are using the capital gains to purchase or construct one residential house in India, is what the section said earlier. Now there has been a slight amendment to the rule, and this I think could be a hot property, could be a likely question for CA intermediate students, because a problem on capital gains is quite commonplace if you're writing the CA intermediate exams. Considering that an amendment has taken place in capital gains, I would think that students should be ready in answering questions on section 54 in the coming exams. So what is the amendment that they have done? Now they are saying that you can invest the capital gains in two residential houses in India. Two residential houses in India, provided they have given a condition. The capital gain that you are exempting cannot be more than 2 crore rupees. Okay, so suppose I have a big bungalow, I sell that bungalow for 10 crores, the indexed cost of acquisition comes to 9 crore, and this 1 crore of capital gain I used to purchase two houses, say one for 40 lakh, the other one for 90 lakh. The capital gain is 1 crore minus 40 lakh minus 90 lakh. My taxable capital gain will be zero, because now that capital gain of 1 crore can be invested in two residential houses in India. Two residential houses in India. Previously, it was, if it was two houses purchased, one for 40 lakh and one for 90 lakh, I would have taken whichever is higher, 90 lakh, given it exemption, and the rest of the capital gain, which is 10 lakh in this case, would have been charged to tax. But now they are saying you can invest it in two residential houses. In my example, 40 lakh and 90 lakh both become eligible, and my taxable capital gain drops to zero. Now remember two things: the residential houses should be in India, and the capital gain cannot exceed 2 crore. They are very clearly told here, look at the PDF that is being shared, that where the amount of capital gain does not exceed 2 crore, he is allowed to purchase the residential house or construct the two residential houses. Okay, understand the point here. Where the amount of capital gain does not exceed 2 crore, the SSE may at his option purchase or construct two residential houses in India. And where such option is exercised, the law further says that this option of purchasing two residential houses or constructing two residential houses and exempting capital gain can be exercised only once in a lifetime. Okay, observe here, he shall not be subsequently entitled to exercise the option for the same or any other assessment year. Now what happens in a given case the capital gains is 2 crore 10 lakh? Please remember, if the capital gain is 2 crore 10 lakh, the entire provision is not applicable. Okay, the provision is just not applicable, which means the old provision will now become applicable. Only one residential house can be purchased or constructed and exemption being claimed. If the capital gain does not exceed 2 crore, you have then the liberty to purchase or construct two residential houses. So keep in mind this particular amendment, because I do think that there is a likely question from section 54 that is coming up in your December exam, because capital gain is a topic on which frequently questions have been asked. Also keep in mind the time limit that is available for purchase of a house, purchase of two houses now, or construction of the house. For purchase, it is 1 year before the date of transfer or within 2 years after the date of transfer, and for construction it is within 3 years from the date of transfer. If you have questions, you can type it in the chat window. I can take it up later too. So Finance Act 2019 introduced Section 54, the changes to Section 54, and then came in another huge amendment, Section 87A. Huge amendment. If not from a CA intermediate exam angle, definitely from a practical angle, this has been a huge amendment that has happened. 87A, which talked about rebate available for SSEs with incomes not exceeding a certain limit. That limit was 3,50,000 till assessment year 1920. Now they have raised it to 5 lakh rupees. This was in the budget of 2019 February, and it was appreciated and criticized for the same reason that this was an election budget and the government was trying to woo voters. Okay, so people from the ruling party angle, ruling party side appreciated this because this was favoring the middle class, and people in the opposition criticized it, saying that the government was trying to bribe middle class voters. But controversies, let them be. We are talking about the exam point of view. Therefore, from now onwards, assessment year 2021 onwards, if the total income of the SSC does not exceed 5 lakh rupees, he is entitled to a rebate of 12,500 from the tax payable by him. So in a given case where the SSC only has normal income, not the special incomes, only normal incomes, okay, the tax payable by him at exactly 5 lakh rupees is actually 12,500. And 87A says if your total income does not exceed 5 lakh, you will get a rebate or a discount of 12,500 from the tax payable before cess. Therefore, up to a normal income of 5 lakh, there is no tax payable for the SSC. Okay, if your income does not exceed 5 lakh rupees, you will get a rebate of 12,500. If your income consists only of normal incomes, and we'll come to what is normal and what is special income very soon, but if you only have normal income in your income tax returns, then you need not pay tax if your income does not exceed 5 lakh rupees. Now, strange thing about this provision is that if your income crosses 5 lakh rupees, the whole rebate disappears. Dear students, please keep this in mind. If your income crosses 5 lakh rupees, 87 it disappears and you have to pay the tax that is calculated. Now, you all must be knowing the income tax slabs. For a citizen who has not attained the age of 60 years, it would be 0 to 2.5 lakh nil, 2.5 lakh to 5 lakh at 5%, 5 lakh to 10 lakh at 20%, and over and above 10 lakh, it is 30%. So 0 to 2.5 lakh nil, 2.5 lakh to 5 lakh, the total amount involved is 2,50,000. This would be taxed at 5%. So 2,50,000 into 5% is 12,500, entirely available as rebate. But the moment you cross 5 lakh, suppose your income is, let's say, 5 lakh 10 rupees, 5 lakh 10 rupees, suddenly there is a tax that is payable by you. Remember this, dear students. Remember this very, very clearly. The moment the total income exceeds 5 lakh, there is no question of a rebate under section 87A. There is no question of a rebate under section 87A. So at 5 lakh 10 rupees, let me just try to calculate. The tax payable by you would be somewhere around 12,502 rupees. Okay, approximated to 12,500 rupees. Okay, or 12,502 rupees plus 4% cess. That entire tax is payable by you. So if there are two people, A and B, imagine this, there are two people, A and B. A has an income of 4,99,999. B has an income of 5 lakh 10 rupees. The difference in income is only 11 rupees. B has an income more than A by only 11 rupees. But A gets rebate of 12,500. Tax payable is 12,500, rebate is 12,500, tax payable is 0. But B at 5 lakh 10 rupees has to fork out 12,500 plus 4% cess. Okay, understand this anomaly that exists in the law. We cannot comment on the anomaly. We cannot comment on the legal provisions, but that's what the law is. Therefore, when that total income problem is given to you, you calculate the GTI, you give chapter 6A deductions, you arrive at the total income, you find that the total income is less than 5 lakh, then most likely there is no tax payable. However, if there are special incomes, tax might still be payable. Okay, now we all know that the tax slab rates are applicable to normal incomes. However, there are certain special incomes. It could be short-term capital gains under section 111A, which is taxable at 15%. It could be long-term capital gains under section 112A, which is taxable at a special rate beyond 1 lakh rupees. There is the casual income, winnings from lotteries, crossword puzzles, etc., which is also taxable at a special rate of 30%. Now, if these incomes come into the picture, the tax payable, even if your income is less than 5 lakh, could be more than 12,500. In that case, you are supposed to give the rebate of 12,500 and calculate the net tax that is payable. Keep this in mind. So if there are special incomes in your solution, even if your total income does not exceed 5 lakh, even if you give a rebate of 12,500 under section 87A, that could still be tax paid. But this is a huge amendment, section 87A, and practically we have found out in our office at the time of filing income tax returns that the moment you come down or come below 5 lakh, then the whole tax payable gets down to nil or zero. Okay, right. Let's now move on to the next section, which was amended, section 194A, tax deduction at source or TDS. Now, TDS is a chapter which some intermediate students give a go by, perhaps not studying it because maybe it is the last chapter, maybe it is a chapter on which hardly any questions are asked. My request to students would be not to do it now with the extra time and super extra time that was made available to all the students because of the cancellation of the exams or merger of May and November exams. I'm pretty sure you might have read this chapter too. Now, TDS is a chapter you have to be extremely careful simply because there are multiple choice questions these days in income tax, and the examiners will have a field day in asking you a lot of multiple choice questions from these chapters: advanced tax, TDS, filing of income tax returns, etc. So these could be some favorite questions of the examiners where limits have changed, where certain rates have changed. Two sections which were changed by Finance Act 2019, Section 194A, which talks about TDS on interest other than interest on securities. There, the threshold limit up to which TDS is not applicable was 10,000 rupees. Now it has been increased to 40,000 rupees. So, for example, if a bank is paying interest to its depositors, if a bank is paying interest to its depositors and interest to a particular depositor does not cross 40,000 rupees, then the bank is not supposed to do TDS. This limit was 10,000, now it would be 40,000. Remember, multiple choice questions. This could be a question. A bank need not do TDS up to rupees dash on the interest on FD. So choices could be 10,000, 20,000, 30,000, 40,000, none of the above. You must be in a position to take 40,000 because that's the threshold limit that is applicable from AY 2021. 194I has also been amended. 194I was TDS on rental payments. So if you are paying rent for your office and the total rental payments for the year crossed 1,80,000, a TDS of 10% was applicable. Now the threshold limit has been increased from 1,80,000 to 2,40,000. As is given here, 240,000 is what the new threshold limit is. So these are the two amendments that have happened in the TDS chapter. The threshold limit under 194A increases from 10,000 to 40,000, and the threshold limit under 194I increases from 1,80,000 to 2,40,000. So these were the amendments introduced by Finance Act 2019, the first Finance Act 2019. I will once again wrap up each of these sections by giving you a very brief explanation on each of them. Section 16, it increased the statutory deduction from income from salaries from 40,000 to 50,000. Section 23 now says that up to two house properties, the SSE can declare them as self-occupied properties. Section 24 talks about a cap on interest on housing loan. It says, before it said that one self-occupied property maximum deduction is 2 lakh. Now they are saying that even if it is two self-occupied property, the aggregate of deduction that you can get for interest on housing loan is limited to 2 lakh rupees. Section 54 speaks about exemption from capital gains when you are selling a residential house. You can purchase or construct now up to two residential houses within the time limit mentioned in section 54, and also only and only if the capital gains that you are proposing to exempt does not or do not exceed 2 crore rupees. 87A now says rebate from income tax is applicable up to a total income of 5 lakh rupees, and the total rebate that would be applicable would be actual tax payable or rupees 12,500, whichever is less. 194A spoke about TDS on interest. The threshold limit was 10,000 before, now it is 40,000. 194, I spoke about TDS on rent. The threshold limit before was 1,80,000. Now it has been increased to 2,40,000. So these were the amendments introduced by the stand-in Finance Minister of India in February 2019. Then the general elections happened. The same government was voted back to power, but we got a new finance minister, a lady finance minister came into the picture, and unfortunately, she inherited an economy which was down, which was absolutely down. So there was a lot of pressure on our incumbent finance minister, Nirmala Sitharaman, to prep up the economy, to boost the economy. And whenever the government or the economists talk about boosting the economy, they usually talk it from the income tax angle. So a lot of eyebrows were raised, a lot of expectations were put upon the finance minister as she came in to present her first budget in July 2019. The amendments are listed in front of your screen. In fact, I am having two screens for the amendments that were done by the finance bill number 2 of 2019 presented in July 2019. Let me once again go to the PDF document, the finance number 2 act of 2019, so as to explain you the changes that have taken place. Here we go. So there are a lot of changes, and as usual, I'm going to focus only on those changes which matter to the CA intermediate students. I'm not going to focus on the surcharge or the rate of tax here because I'm going to have a separate slide on the surcharge that is applicable for AY 2021. I'm not going to pick up certain sections which are not applicable for CA intermediate students. They might be applicable for the CA final students, but that wouldn't matter for an intermediate student. So here we go. There have been many amendments that have taken place in Finance Number 2 Act of 2019. The amendments are listed here, but I'm only going to pick up the amendments that are applicable or that are relevant to the CA intermediate students. Let me start with the amendment in Section 9 of the Income Tax Act. Now, Section 9 of the Income Tax Act talks about income deemed to accrue or arise in India. Income deemed to accrue or arise in India. Now, if you could remember a little bit on the history of this particular section, uh, you have a chapter called Rule of Residence and Incidence of Tax Based on Residence. Now, in this particular chapter, you have incomes chargeable to tax in the hands of an ordinarily resident, income chargeable to tax in the hands of a not ordinarily resident, and income chargeable to tax in the hands of a non-resident. What incomes are chargeable in the hands of an ordinarily resident? Income which accrues or arises in India, income which is deemed to accrue or arise in India, income which is received in India, income which is deemed to be received in India, and income which accrues or arises outside India. What is taxable in the hands of a not ordinarily resident? Once again, income which accrues or arises in India, income which is deemed to accrue or arise in India, income which is received in India, income which is deemed to be received in India, and income which accrues or arises outside India, provided it is out of a business which is controlled in India or a profession which is set up in India. In the hands of a non-resident, the following incomes are taxable: income which accrues or arises in India, income which is deemed to accrue or arise in India, income which is received in India, income which is deemed to be received in India. Now, the common points among the three, ordinarily resident, not ordinarily resident, and non-resident, is income which accrues or arises in India or is deemed to accrue or arise in India, income which is received in India or is deemed to be received in India. In all the three cases, these two types of incomes are taxable. Now, what do you mean by deemed to be received in India, and what do you mean by deemed to accrue or arise in India? There are two sections which talk about this. Section 7 defines what is deemed to be received in India, and Section 9 defines what is deemed to accrue or arise in India. Section 9 therefore is quite a popular section at the CA intermediate stage, and also very much at the CA final stage. And also practically as a chartered accountant, Section 9 is an extremely important section because it rolls out several points which talk about incomes which are deemed to accrue or arise in India. This is a section which was not touched by many finance ministers in many budgets. But after a long time, an amendment, an extra addition has been made to this particular section, section 9. In listing out incomes which are deemed to accrue or arise in India, one final point has been added, which is point number 8. Now they are saying that income arising outside India, being any sum of money paid on or after 5th day of July 2019 by a person resident in India to a non-resident, not being a company or to a foreign company. Okay, to tell this in common man's language, any gifts given by a resident to a non-resident on or after 5th day of July 2019 is deemed to be the income of the non-resident by virtue of section 9 clause 8. Okay, so if you are a non-resident, you receive a gift by way of any sum of money from a resident, no matter where you are, it is deemed to accrue or arise in India, and it's an income which is taxable in India. Understand this particular point, because I expect maybe half expectation that a point on this particular amendment could arise in your exam. So imagine a situation where Mr. A is a non-resident in India. He is a citizen of US, and Sridhar Kamath gives him a gift of 1 lakh rupees by way of check. Okay, he is always in US. He has perhaps never come to India. He gets a gift of 1 lakh rupees from Sridhar Kamath. Okay, now this sum of money received as a gift from a resident is deemed to accrue or arise in India in the hands of A by virtue of operation of section 9 of the Income Tax Act. So remember, gift by way of any sum of money received by a non-resident from a resident is deemed to accrue or arise in India under section 9 of the Income Tax Act. Section 9A, amendments to Section 10 may not be that important, so I'm skipping them and moving further. 12AA is about charitable or religious trusts, which might not be applicable. 13A, 35AD, these are pretty insignificant amendments. But let's move on to Section 40. Okay, may not be important, may not be asked in your exam, but because Section 40 appears in your syllabus, I made it a point to include Section 40. A small amendment has taken place in Section 40. Section 40 Clause A. What does Section 40 Clause A say? Section 40 Clause A says that in the case of an SSE carrying on a business or profession, if for any payment TDS needs to be done and TDS is not done, or TDS needs to be done, TDS is done, but the TDS is not paid to the government, then this particular payment or expenditure in the hands of the SSE is disallowed. If the payment is to a non-resident, the entire payment or expenditure is disallowed. If the payment is to a resident, then 30% of the payment or expenditure is disallowed. Okay, that's what section 40 said. For instance, suppose I am carrying on a business and I pay rupees 1 lakh as professional charges to my lawyer. The law says 10% TDS needs to be done on 194J. So 10% of 1 lakh 10,000 needs to be cut from the payment. 90,000 needs to be paid, and this 10,000 needs to be deposited to the government. Now, A, I don't deduct 10%, I pay him the entire 1 lakh, then it is disallowed. B, I deduct 10,000, pay him 90,000, but I don't pay 10,000 to the government at all. Then also this expenditure of 1 lakh is disallowed. That's what section 40 clause A says. If the payment is to a non-resident, the entire payment is disallowed. If the payment is to a resident, then only 30% of the payment is disallowed. Now section 40 clause A subclause 1 has been amended to say that, in my example, to the lawyer to whom I have made a payment of 1 lakh, if he offers this 1 lakh to tax and pays tax on this 1 lakh, then in my hands the disallowance drops and I can get a deduction for the expenditure made. Please look at this particular paragraph, slightly legal jargons, but still let's make an attempt. Provided further that where an SSE fails to deduct the whole or any part of the tax in accordance with the provisions of Chapter 17B on any such sum, but is not deemed to be an SSE in default under the first proviso to subsection 1 of section 201, then for the purposes of this subclause, it shall be deemed that the SSE has deducted and paid the tax on such income, on such sum, on the date of furnishing the return of income by the payee referred to in second proviso. A bit difficult to understand, but remember this. In case the lawyer to whom I have paid 1 lakh without TDS offers that 1 lakh to tax and pays tax on that 1 lakh rupees, then in my hands, the disturbance is not applicable. The entire 1 lakh is or becomes a deductible expenditure. Okay, that was section 40 for you, included in your syllabus. Hence, I made an attempt to explain this. 40A has been amended, but may not be that important. 43 has been amended, may not be that important. Section 43B has been amended. Now, 43B, what did it tell? 43B spoke about expenses in the hands of an SSE carrying on a business or profession, expenses which are deductible only on actual payment basis. So in the case of these expenses which are listed in section 43B, though they are deductible, because section 43B says so, they are deductible only if they are actually paid. Okay. Do you remember what expenses were included in section 43B? There were expenses like any tax, duty or cess payable to the government, bonus payable to the employees, employers' provident fund contribution, any contribution to gratuity fund or any other fund set up for the welfare of the employees, interest on bank loan, etc., etc. So there were a list of expenses. One more is added to that list, which may not be important, but this is what is added. Any sum payable by the SSE as interest on any loan or borrowing from a deposit taking NBFC, non-banking financial company, or systematically important non-deposit taking non-banking financial company in accordance with the terms and conditions of the agreement governing such loan or borrowing. So in case the loan is taken from a bank, 43B was applicable. Now, even if the loan is taken from a deposit taking non-banking finance company, or if the loan is taken from a systematically important non-deposit taking non-banking finance company, then also 43B is applicable. May not be that relevant, but I somehow thought it fit to mention here. That was 43B for you. Let's move on. They then define what is a non-banking finance company, what is a deposit taking non-banking finance company, etc. 43CA, 43D amendments may not be important. 44AD may not be important. Section 47, 50C, 50CA have been amended, may not be important at your level at all. Section 56 has also been amended, that may not be applicable or important. 79, set off and carry forward of loss has been amended, which may not be important. Let's now move on to the amendment to 80C. 80C is a very, very important section in the income tax law. And though you have been told in your class that you need not remember the sections in the Income Tax Act, everyone would be happy if you could quote at least this section if a problem is asked on this section, which is 80C. 80C problems are quite commonplace for SEA intermediate students, either as a stand-alone problem on Chapter 6A deduction or as a problem on computing total income where certain 80C deductions are also given. Now there has been an amendment to section 80C of the Act, very simple amendment, where they are saying that contribution to a pension scheme for a central government employee is also eligible under section 80CCD. Okay, contribution to a pension scheme by a government employee is eligible under section 80C. Okay, now the time limit for this is 3 years and it should be a scheme as may be notified by the central government. So contribution to a pension scheme is also eligible for deduction for a central government employee under section 80C. 80CCD subsection 2 has been amended, and this is quite important. 80CCD talks about national pension scheme. 80CCD subsection 1 and subsection 1B talks about employees contribution to national pension scheme, and 80CCD subsection 2 talks about employers contribution to national pension scheme. As far as ATCCD 1 and 1B employees contribution to NPS, the limit was 10% of the salary or 20% of the GTI if the SSE is a self-employed SSE, along with a total deduction, maximum deduction of 50,000 under ATCCD 1B. As far as the employer's contribution to NPS goes, which is covered by ATCCD subsection 2, there was no threshold limit. The only limit was 10% of the salary of the employee. Now, that 10% of the salary of the employee has undergone a slight change, where they are now saying under 80 subsection 2, the employer's contribution to NPS is deductible subject to a maximum limit of, in the case of a private employee, 10% of the salary. But in the case of a government employee, that too a central government employee, the limit now is 14% of the salary. Students, please make note of this particular amendment because ATC, ATCCD are sections on which questions could be asked. The threshold limit for a central government employee right now is 14% of the salary for employer's contribution. As far as a non-government employee goes, or even an employee of the state government, the limit stays at 10% of salary. But if you are an employee of the central government, then the limit is 14% of the salary. Okay, keep in mind this particular amendment. Let's move on beyond ATCCD. Two new sections have been introduced under Chapter 6A and are very relevant to a CA intermediate student. These two sections are ATEEA and ATEEB. These two sections are ATEEA and ATEEB. Two new sections, and highly likely that a question will be asked on ATEEA and ATEEB. I hope you have taken down notes on ATEEA and EEB. Very, very important, very simple sections, both of them. Let us start with ATEEA. ATEEA talks about interest on housing loan. ATEEA says if you have a housing loan and there is interest on this housing loan, under ATEEA Chapter 6A, you will get a deduction of 1,50,000 of such interest on housing loan. Okay, the bottom line as far as ATEEA says that if you have a housing loan on which you have paid interest during the year, you will get a deduction of that interest on housing loan subject to a maximum of 1,50,000. There are of course a lot of conditions that are associated with ATEEA. This deduction of 1,50,000 for interest on housing loan is available if the following conditions are satisfied. Condition number 1, the housing loan is taken in 2019-20. Students, please observe, the loan is taken from 1/4/2019 or to 31st March 2020. The loan should have been taken in 1920. Number 1. Number 2, the value of the house is not more than 45 lakh rupees. If the value of the house is more than 45 lakh rupees, then ATEEA is not applicable. If the value of the house is less than 45 lakh rupees only, or if it does not exceed 45 lakh rupees only, then ATEEA is available. Number 3, the SSE cannot own any other house on the date of sanction of the loan. Okay, so if the loan is sanctioned today and I already own a house, then ATEEA is not applicable. Okay, this should be my first house, only then ATEEA is applicable. And last point, if a deduction is taken under this particular section, then the same deduction is not available under any other section. Now this is a slightly tougher thing to understand. Okay, ATEEA says if you take deduction for interest on housing loan under this section, you can get it up to 1,50,000 provided all these conditions are satisfied. And if you take a deduction here for the same amount, you cannot take a deduction elsewhere. Now students, you must understand and know that there is a chapter called income from house property where you get deduction for interest on housing loan. Okay, there is a cap for the deduction of interest on housing loan. For a leasehold property, there is no cap. For the self-occupied property, there is a cap of 30,000 or in certain cases 2 lakh rupees. Now, ATEEA is in addition to this particular deduction under section 24. So 80EEA usually comes into the picture only in this case. You have got an interest, you have got a self-occupied property, and your interest on housing loan is say 4,20,000 rupees. The interest on housing loan is 4,20,000 rupees. Now, how will you get deduction? You will get a deduction of 2 lakh there under section 24 as loss from house property, and further you will get a deduction of 1,50,000 under section 80EEA, because all conditions under section 80EEA are satisfied. The house value is less than 45 lakh rupees, or it doesn't exceed 45 lakh rupees. The loan is taken during 2019-20. The loan is taken from a financial institution, and the assessee does not own any house on the date of sanction of the loan. So over and above the deduction that you are getting under section 24, you can claim a deduction here under 80EEA. This of course does not make sense if the house is let out, because under section 24 in any case you are getting a limitless deduction. You can then come to section 80EEA. Now, suppose the maximum loss from house property allowed under section under set off and carry forward of losses is 2 lakh rupees only. So, if your interest crosses 2 lakh rupees, then there could be a case wherein you can come to section 80EEA and take deduction under chapter 6A. So, students, please remember 80EEA. This could be a section on which questions could be asked. If you have doubts, you can type this in the chat window, and let's move on to section 80EEB. Another new section. This section talks about electrical vehicles. Again, very simply, let's not go deeper into this section, but let us understand this section in the simplest of sense. 80EEB is applicable if you take a loan for the purchase of an electric vehicle. If you take a loan for purchase of an electric vehicle, then the interest on this loan is deductible under 80EEB, subject to a maximum of 1,50,000. Okay, the maximum limit under 80EEB is 1,50,000. Subject to this maximum, interest on loan taken for purchase of electric vehicles is deductible under chapter 6. Have this in mind. This could also be one of the questions that are asked in the December exam. In fact, 80EEA and 80EEB, they can ask questions on both these sections. There is one condition that you have to be careful here for. The time limit given for taking the loan for purchase of an electric vehicle is not just 2019-20, but 1st April 2019 to 31st March 2023. There is a good 4-year time period that is given for taking of the loan under 80EEB, unlike 80EEA, where the loan for purchase of the house should be taken during 2019-20. Okay, should only be taken 2000 in 2019-20. There is one aspect of 80EEA which I missed out. There is one aspect of 80EEA which I missed out. Only loan taken for purchase of a house property is eligible for deduction under 80EEA. Not the construction, but only for acquisition of a house property. See the words used here under 80EEA, for the purpose of acquisition of a residential property. Okay, only for the purpose of purchase of a residential property 80EEA is available. So these are two very important sections which were amended by Finance Act 2019 number 2, 80EEA. In fact, not amended, they were brought in by Finance Act number 2, 2019, 80EEA and 80EEB. And in my opinion, students should be extremely careful with regard to these two sections, because there is every likelihood that a question will be asked. 80JJAA slightly amended, may not be important at this level. 80LA, a new section, it talks about Indian branch of a foreign bank, may not be important at your level, so I'm going to skip 80LA. 92CD talks about transfer pricing, 92CE talks about transfer pricing. This isn't, yeah, this isn't a section that is applicable at the intermediate level. This is a section which is only applicable at the CA final level. Okay, there is a query that is raised. Can a non-resident claim deduction under section 80TTA? The answer is yes. A non-resident can claim deduction under section 80TTA. Deduction is available for a non-resident under section 80TTA. 80TTA, of course, is applicable to savings bank account interest income of individual SSEs. So 92 CE is done. Let's move. I mean 92 CE is not applicable, so let's skip this. Let's move to 92D. There are a whole host of sections which are not applicable. 115 JB, 115 O, 115 QA, 115 R. All these sections are not applicable at the CA intermediate stage. But let's move on. 139A is applicable. 139A is a section which talks about uh, obtaining of PAN number. So 139A uh, is applicable. It's a theoretical portion. I can even skip this, but please see the change that has happened for 139A subsection 5E of the Act, where they are talking about intimation of the PAN in various documents. Um, I will skip this and move further. 140A talks about computation of the self-assessment tax may not be important. 143 may not be important. Let's move on to 194BA. So we are back again to learning the sections on TDS. 194DA talks about compensation paid by an insurance company. Okay, 194DA talks about compensation paid by an insurance company. So when the sum assured in the life insurance policy is paid to the person whose life is assured, there could be a case of taxability of such policy. Now, the taxability of such policy is discussed under section 10, where you perhaps must have been told that in case the annual premium exceeds 10% of the sum assured, and in some cases 15% of the sum assured, then the 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 surrender value of the policy at the time of maturity becomes taxable. Now, 194DA previously talked about cases where when the insurance company pays you the surrender value of the policy, it does TDS directly at 1% on the surrender value. But with effect from AY 2021, they have brought in a change where they are saying that A, the rate of TDS now is 5%, and B, TDS needs to be done only on the income component of the policy matured. Okay, take for example, there is a policy where I pay a one-time premium of 1 lakh rupees, and the policy says if for the next 5 years you survive, we will pay you 3 lakh rupees. Okay, I'm paying a one-time premium of 1 lakh rupees in a year, and the policy says if you survive for the next 5 years, then we will pay you 3 lakh rupees. If you die anywhere in between, also we will pay you 3 lakh rupees. Of course, not to you, but your legal heir. But if you survive till the end of the fifth year, then we will pay you 3 lakh rupees. Now, this is a policy which is chargeable to tax because the annual premium exceeds 10% of the sum assured. The annual premium is 1 lakh, one time premium, and the sum assured in this case is 3 lakh rupees. It exceeds 10% of the sum assured, hence therefore this policy is taxable. Now, at the expiry of the fifth year, when the insurance company makes the payment of 3 lakh rupees to the person whose life was assured, presuming that he is alive, when the insurance company pays 3 lakh rupees, previously TDS at 1% should have been done on 3 lakh rupees. Previously, that is before assessment year 2021, TDS at the rate of 1% should have been done on the 3 lakh rupees. Now the law has been amended on two counts. Number one, the rate of TDS now has jumped from 1% to 5%. And now they are saying to do TDS on the amount of income comprised therein. They are asking the insurance company to do TDS on the amount of income comprised therein. What does it mean? I am the policy holder. I paid a premium of 1 lakh today, and after 5 years, I am getting an amount of 3 lakh rupees. What is my income from this policy? My income from this policy would be 3 lakh minus 1 lakh. My income from this policy is 2 lakh rupees. The same instruction is now given to the insurance company that don't do TDS on 3 lakh, but do TDS on the surrender value of the property less premium paid for the policy. Do the TDS on the income comprised in the policy. The income comprised in this policy is 2 lakh rupees. Okay. Therefore, before this amendment, the insurance company would do TDS at the rate of 1% on 3 lakh. After this amendment, in my example, the insurance company would do a TDS of 5% on 2 lakh rupees. A TDS of 5% on 2 lakh rupees. Have this in mind, 194BA. 194IA has also been slightly changed. 194IA talks about TDS when an immobile property is sold. The threshold limit here is 50 lakh rupees. The consideration for the immobile property would be consideration, but now they have defined what is the meaning of consideration, and they have defined to include charges of the nature of club membership fee, car parking fee, electricity or water facility fee, maintenance fee, advance fee, or any other charges of similar nature which are incidental to the transfer of the immobile property. For example, suppose I am purchasing an apartment. The value of the apartment is say 75 lakh rupees. So I have to do TDS on 75 lakh rupees before I pay the net amount to the builder or to the owner of the apartment. Okay, so 75 lakh rupees into 1% is the TDS that is applicable. The threshold limit under 194 IA is usually 50 lakh rupees. Here, as the consideration is 75 lakh rupees, I have to do TDS at 1% on 75 lakh rupees. Now, the amendment to 194 IA says the cost of the flat is 75 lakh rupees. But I have also purchased a parking space before for my car, and the builder has charged me an additional 2.5 lakh rupees for the parking fee. Now the law says TDS of 1% is not just applicable to 75 lakh rupees, but 75 lakh rupees plus 2.5 lakh rupees or 77 lakh 50,000. The TDS is applicable to 77 lakh 50,000 because now they are saying consideration should include all charges of the nature of club membership fee, car parking fee, electricity or water facility fee, maintenance fee, advance fee, or any other charges of similar nature which are incidental to the transfer of the immobile property. Have this in mind. Previously, it would have been only for 75 lakh at the rate of 1%. Now it would be 75 lakh plus any other charges. In my example, there was a car parking fee that was recovered. Even the car parking fee should be added to the consideration and TDS collected. Now, two new sections have been introduced by Finance Act 2019 number 2, 194M and 194M. Considering the complexities involved in both these two sections, one might generally presume that these two sections might be asked at the CA final stage. But without taking any chances, let me very briefly explain you what is 194M and what is 194N. 194M for the first time says if an individual or HUF is making payment to any contractor for carrying out any work, okay, if an individual or an HUF is making payment to any contractor for carrying out any work and such payment exceeds 50 lakh rupees, then a TDS at the rate of 5% has to be done by the individual or the HUF. Okay, please understand this is a purely personal contract. Usually the TDS provisions, even the income tax provisions, don't come near a personal contract or a personal expenditure. But here the law under 194M says that if you are, for instance, suppose you are building a house, you are building a very posh house, and the contractor gives a cost estimate of say 60 lakh rupees. Now in this case, as the consideration paid to a contractor crosses 50 lakh rupees, which is 60 lakh rupees, the individual concerned who has hired the contractor has to make a TDS of 5% on this 60 lakh rupees. That's what section 194M says. There are a bit of other complications here also, but let's move on to 194N. Sorry, the PDF jumped page. Let's move on to section 194N, a very, very controversial provision in the income tax law. And this is a provision on which questions might not be asked for the simple reason that one of the high courts of our country have stayed the application of this section. Okay, 194N talks about a case wherein cash withdrawals from a bank or a cooperative bank or a post office, TDS is applicable. Okay, so I'm withdrawing cash again and again and again and again and again. And the bank finds out that my total aggregate cash withdrawals during the financial year are crossing 1 crore rupees. Now, the section 194N instructs the banker to deduct 2% the moment it exceeds 1 crore rupees. Okay, an amount equal to 2% for sums exceeding 1 crore rupees, income tax needs to be deducted. Okay, this is the provision by section 194, and this is extremely controversial. There are a lot of circulars and notifications that have come out on section 194N, which might not be relevant or important at your age, at your level, but this is all that you have to remember, that in case I withdraw cash from a bank, from a cooperative bank, or from a post office, and the aggregate of withdrawals cross 1 crore rupees, then the bank or the cooperative bank or the post office is supposed to do a TDS at the rate of 2% from the withdrawals over and above 1 crore rupees. That is 194N for you. I understand it is slightly difficult, but think that should be it. There are amendments in section 197, 198, 201, 206A, which might not be relevant at your level, 228A, 234A, etc. 234B and so many other sections are may not be applicable at your level. So that's the thing I wanted to talk about, the amendments by Finance Act number 2, 2019. As you can see here, I've written them in 2 pages. And once again, for the benefit of everyone who has gathered here, let me try to summarize the amendments done by Finance number 2 Act 2019. So I have only taken the important amendments which I feel could be asked in your exams. Let's start with section 9. It has extended the meaning of deemed to accrue or arise to even cover any sum of money received by way of gift by a non-resident from a resident in the country. Section 40 talks about TDS defaults and disallows full expenditure or 30% of the expenditure depending upon who is the person to whom the payment is made, whether he is a resident or a non-resident. Section 40 now says that if such resident or non-resident has declared that income in his income tax returns and paid tax on it, then on the part of the deductee, on the part of the assessee carrying on business, there is no obligation to do TDS and therefore there is no disallowance. Section 43B has added to an already long list of expenses which are available for deduction only on payment basis one more expenditure, which is interest on loan taken from NBFC or deposit taking NBFCs. Section 54GB has been amended. I mean, this is a section which perhaps I skipped. Section 54GB has also been amended. Section 54GB talks about exemption from capital gain in certain cases. Give me a minute. Yeah, 54GB. 54GB said that if you are shifting industrial undertaking from a urban area to a rural area, and as part of the shift you are acquiring a lot of assets, that to the extent of the cost of the asset you will get exemption from the capital gain that you make on the sale of the business, or rather on the shifting of the business. Now 54GB further said that in case you purchase new assets and claim exemption under 54GB, such new assets should not be sold for a period of 5 years, if I remember correctly, 5 years. Now they are saying if the new asset purchased by you is computer or computer software, then even if they are sold after 3 years, it's okay. Okay, for every other asset, it is 5 years, but for computer or computer software acquired by an eligible startup, then the lock-in period is 3 years and not 5 years. Lock-in period is 3 years and not 5 years. So that is 54GB for you. You have got 80C where contribution to a pension scheme is now eligible as deduction. 80CCD subsection 2 where now the employer's contribution is deductible subject to 10% of salary of the employee in the case of non-government employee, but in the case of a central government employee, if it is 14% of the salary of the employee, that is 80 CCD for CCD subsection 2 for you. 80EA, interest on housing loan, maximum deduction is 1,50,000. Loan should be taken during 1920 and the stamp duty value of the house should not exceed 45 lakh. 80EEB, interest on loan taken for purchase of an electric vehicle, the maximum deduction available is 1,50,000. Section 139 has been slightly amended. Maybe this is also something that I missed out. I'll just explain this. 139 is a section on which many a times questions have been asked. So I fear maybe this year also they might make it a point in asking about section 139. So give me a minute. Yes. Okay. Yes. There is one thing that I missed out. Under section 139, when should income tax returns be filed? When should income tax returns be filed in section 139? Uh, the simplest instance is a case wherein your income crosses the basic exemption limit, the maximum amount not chargeable to tax, you have to file your income tax returns under section 139. If your gross total income exceeds 2 lakh 50 or 3 lakh or 5 lakh, depending upon your age, then you are required to file income tax returns. Now, in addition to this, section 139 has been now amended, and they are saying that the following people should also file income tax returns irrespective of their actual income. Who are these following people? Number one, has deposited an amount or aggregate of the amounts exceeding 1 crore rupees in one or more current accounts maintained with a banking company or a cooperative bank. So if the total amount deposited in a bank is 1 crore or more, then you have to file your income tax returns. Needless to say, if you are depositing so much of cash, one would obviously presume that you have got taxable income and you are filing your income tax returns. But still, the government thinks it fit to make such a provision, could be because there are many instances where, despite depositing 1 crore rupees or more in a bank account, SSEs are not filing their income tax returns. Could be so, but this is one such case. There are several more. Expenditure incurred exceeding 2 lakh rupees for travel to a foreign country. Okay, even they are required to file income tax returns. Expenditure of an amount or aggregate of the amounts exceeding 1 lakh rupees towards consumption of electricity. So if your electricity bill aggregate to more than 1 lakh rupees, then you have to file your income tax returns and fulfill such other conditions as may be prescribed. So these three are the most important points under section 139 where you are required to file income tax returns. Number one, I have deposited more than rupees 1 crore in the current accounts of a bank. Number two, I have incurred an expenditure exceeding 2 lakh rupees on travel to a foreign country. Number three, my total electricity bill for the year comes up to more than 1 lakh rupees. In these three cases, even if my income does not cross the maximum amount of income not chargeable to tax, I still have to file my income tax returns. Pretty insane, pretty peculiar, but that's how the rule of law is. So we have studied section 139, we have studied section 194BA, which talks about compensation paid by an insurance company. The rate now is not 1% but 5%, and the compensation and the TDS to be done on the income part of the compensation. 194IA talks about TDS on consideration of immovable property. The consideration would now include a whole host of other charges also. 194M talks about payment to a contractor and 5% TDS to be done. 194N talks about payment to a, I'm sorry, withdrawal of cash by an SSE and rate of TDS that is applicable. So let's now move on to the last few slides. So I had started with Finance Act 2019 and then I moved on to Finance Act number 2 2019. So after the budget was presented in the month of July 2019, there was a lot of brickbats that our finance minister faced, a lot of criticism that she was not able to revive the economy no matter what. So the finance minister decided to make certain amendments to the Income Tax Act through an ordinance dated 20th September 2019. The ordinance was passed by both the houses of the parliament and now this has turned into an act. Now, the surcharge needs to be told here. What is the surcharge that is applicable to the income of the SSE? Now, I have made a list of these surcharges, I'm only talking from an individual's point of view. If the total income exceeds 50 lakh but does not exceed 1 crore, the rate of surcharge is 10%. If the total income exceeds 1 crore but does not exceed 2 crore, the rate of surcharge is 15%. If the total income exceeds 2 crore but does not exceed 5 crore, the rate of surcharge is 25%. And if the total income exceeds rupees 5 crore, the rate of surcharge is 37%. Okay, these are the rates of surcharge. Please keep these rates in mind. Please keep these rates in mind. This could be a question which would definitely be asked both at the CA intermediate stage as well as the CA final stage, because it's not the complexity about the surcharge that matters. It is the amendment made by the Taxation Laws Ordinance 2019 dated 20th September 2019 that matters, where they are saying that if you have incomes under section 111A or section 112A, then the rate of surcharge applicable to this income is cannot exceed 15%. Understand this point very clearly, and I fancy a question on this particular point in your exams. If you have got incomes under section 111A and section 112A, what is 111A? Short-term capital gains on sale of uh, shares listed in the recognized stock exchange, units of an equity-oriented fund, or units of a business trust, where STT is paid. This is short-term capital gains covered by section 111A, which is taxable at a flat rate of 15%. Remember, special incomes that we were discussing at the beginning of this session. This is one of those special incomes. What is section 112A? The same capital gains, but this time long-term capital gains. We are again talking about equity shares in listed in a recognized stock exchange, units of an equity-oriented fund, or units of a business trust. If it is short-term capital gain, taxable at 15% under 111A. If it is long-term capital gain, taxable at 10% over and above rupees 1 lakh as long-term capital gains. If these incomes are part of your total income, and surcharge is applicable to your total income because it either crosses 50 lakh or 1 crore or 2 crore or even 5 crore, then the amendment done in the ordinance says the rate of surcharge applicable to these incomes cannot be more than 15%. Very strange, but that's how the law is. Okay, so they are saying for your total income crossing say 5 crore, the rate of surcharge is 37%. But for the portion of the total income which is represented by STCG under 111A or LTCG under 112A, the rate of surcharge applicable is only 15%. Okay, seems a little peculiar, but here we go, 15%. So here there are rates of surcharge given 10%, no problem, 10% for all incomes, including incomes under 111A or 112A. 15%, absolutely no problem. Once again, 15% would be the rate of surcharge applicable to your entire total income. But if the surcharge jumps to 25% because the income crosses 2 crore, it doesn't cross 5 crore. Or if the surcharge jumps to 37% because the income crosses 5 crore. Now the law says, okay, fair enough, you apply 25% and 37% on every other income. But when it comes to STCG under 111A or LTCG under 112A, the maximum rate of surcharge that would be applicable would be 15% only. Would be 15% only. Once again, I would like to warn the students who are watching this video here that this could be a really hot question come your December intermediate exams. They could just give you some incomes, including incomes on 111A or incomes on 112A, and ask you to calculate the total tax that is payable, including cess and surcharge. It would be a challenge, because if there are incomes on 111A and 112A as well as other incomes, to bifurcate and understand that if there are incomes on 111A and 112A, the rate of surcharge cannot exceed 15%. Okay, now for the ones who are a bit confused on how exactly this surcharge operates, I would recommend you to read the latest RTP that is available in the institute website, where they have broken down this particular surcharge methodology into 4 or 5 examples and explained in very clear terms how does the operation of surcharge works. Okay, if by the end of this session, if I've got time, I myself can show you on the screen what has the RTP got to talk about it. But in case you have got time, please refer to the RTP and understand through examples how does the rate of surcharge work. Now, due to limited time, I may not be able to explain you the how does a surcharge work, but you can refer to the RTP to understand how does the surcharge work. So this was the amendment made by yeah, this was the amendment made by the Taxation Laws Amendment Ordinance 2019 dated 20th September 2019, where they said that incomes under 111A and 112A cannot be subject to a surcharge of over and above 15%. Let's now move on to Taxation and Other Laws Ordinance of 2020. This is an ordinance that was brought into the picture after the lockdown announced by the Prime Minister dated 23rd March 2020. There was a hue and cry that the economy, which is already down, would be perhaps taken to the cleaners with the lockdown looming large. Everyone sits at home, no business activity takes place, no professional activity takes place, people do not earn income, the government does not earn income, and where does this ultimately take us? But considering the lockdown imposed by Corona, considering the general hardship caused to people due to the lockdown imposed, a lot of time limits available in the law got extended. Okay, a lot of time limits available in the law got extended. Now, a note of caution before I start explaining you the extension of time limits. The RTP does mention the revision test paper applicable for November 2020 does mention that all changes up to 30th April 2020 are applicable to the CA intermediate exams. But the RTP itself does not talk about this ordinance at all. Now, this ordinance has a couple of extension of time limits applicable only to assessment year 2021. And then it has got several more extension of time limits which are applicable to AY 21-22. Now, AY 21-22 is not applicable to you. You are only writing AY 2021. But because it was passed on 31st March 2020, I thought it fit to be explained to explain it in this platform so that you at least have in the back of your mind what are the extension of time limits introduced by this particular ordinance. Here we go. So there are some extension of time limits. First of all, for financial year 2018-19, the last date by which income tax returns could have been filed was 31st March 2020. After that, income tax returns couldn't be filed. Now, I hope everyone knows that the time limit available for filing of income tax returns is the due date for filing income tax returns, which is usually 31st of July of the assessment year for individuals and 30th September of the assessment year if you have got a business or profession which is subject to audit. Okay. Now, even after the due date, you can file income tax returns. But the maximum time limit available would be the 31st of March of the assessment year. So if you are talking about, say, the previous year 2017-18, 31st July 2018 is the first due date, 30th September 2018 is the second due date, and 31st March 2019 is the last date by which anything can be filed. After that, no income tax returns can be filed in relation to 2017-18 previous year. Same applied to financial year 2018-19 that the last date for filing income tax returns after which the returns can't just be filed in the website. The last date was 31st March 2019. The last date was 31st March 2019. Okay. Now, because of the lockdown imposed due to COVID-19, the government has relaxed this last date to 30th June 2020, which means returns for financial year 2018-19 for which the returns could have been only filed in assessment year 1920 up to 31st March 2020, now could be filed even on 30th June 2020. Now, for the information of everyone, this 30th June 2020 got further extended to 31st July 2020, which got further extended to 30th September 2020, which again got further extended right down to 30th November 2020. So, as of today, 22nd October 2020, I can still file income tax returns for financial year 2018-19 or assessment year 1920. Extension of Aadhaar or PAN linking may not be necessary for you. Now, point number three is extremely important, and this is the reason why I am taking up this ordinance to students who are writing November 2020 exams. Point number three says, okay, point number three says, only for the financial year 2019-20, only for the financial year 2019-20, the time available for making investments under Chapter 6A, which should have been done in the previous year 2019-20, is extended to 30th June 2020. Very, very peculiar this particular extension, but perhaps it was the need of the hour because of the lockdown imposed in the last few days of the previous year. So for 2019-20, you have to make investments in 1920 to get deduction in AY 2021. But for the first time ever, the government is saying now that for 2019-20, even if you make the investment later in April or May or June 2020, you can still claim deduction for this in 2019-20. Students, be very, very careful. The RTP does mention that amendments up to 30th April are applicable. So in case the Chapter 6A deduction given by them are given here, the date for making various investments or payments for claiming deduction under Chapter 6A Part B of IT Act, which includes Section 80C, LIC, PPF, NSC, etc., Section 80D, Mediclaim, 80G, donations, etc., has been extended to 30th June 2020. Hence, the investment or payment can be made up to 30th June 2020 for claiming the deduction under these sections for financial year 2019-20. Therefore, students, be mindful that tomorrow during the exam you get a problem where they are saying that PPF investment 1 lakh done on 1st January 2020, NSE investment 20,000 done on 2nd April 2020. Usually, if the investment is done on 2nd April 2020, you would have considered it for Chapter 6A for PY 2021. But here, due to this exceptional case, that investment done in the month of April 2020 can also be claimed, rather can only be claimed for PY 1920. Okay, for PY 1920. Now, this 30th June 2020, which was the last date, has now been extended to 31st July 2020, and that was that. After that, there were no further extensions. But remember, once again, if you have got Chapter 6A investments done after 31st March 2020, then also the deduction is available for calculating total income for PY 2019-20. The same applies to investments or construction of investments for construction or purchase of a residential house or any other benefit from 54 to 54 GB. If the time limit was to expire up to 30th June 2020, then they are saying that if the time limit was to expire up to 31st March 2020, then they are saying that even if it is done by 30th June 2020, it would be enough. The 10AA amendment may not be necessary. Uh, the reduction in the rate of interest for TDS may not be that important. The Vivad Se Vishwas scheme also may not be that important. But from this particular ordinance, you have to remember two things. Number one, that you can file income tax returns for PY 1819 or AY 1920 even after 31st March 2020. The date as of today is extended up to 30th November 2020. So I can still file AY 1920 returns. That's number one. Number two, you should also understand that for PY 1920, even if the Chapter 6A investments are done after 31/3/2020, they are eligible for deduction for PY 1920. So in case somewhere in the problem they say investment in PPF is done on 26th April 2020, then you need not take it for PY 2021 or AY 21/22, but you can take it for PY 1920 or AY 2021. That is the taxation and other laws relaxation of certain provisions ordinance 2020. Students, if you have got doubts, you can always ask. Let's move on to the last part of my session, the changes in the rate of depreciation. This is also extremely important, and I fancy a question on this because this is a change that was once again done by the finance minister somewhere in the month of August of 2019. Once again, I've been telling this many on many occasions in the last 2 hours, but once again the economy was tanking. The demand was extremely low, and one of the industries that were affected a lot was the automobile industry, which saw dip in sales. Okay, now the automobile industry is one of those industries which drives the economy single-handedly, because there are so many other manufacturing industries that are dependent on the automobile industry. So if the car sales, the bus sales drop, automatically there is concern, and automatically it's a sign that the economy is not doing well. So here comes our dear finance minister. She has a press release, and on 23rd August 2019, she gives away two emoluments to the automobile owners. So read this out very clearly. The rates of depreciation applicable to vehicles has been changed with effect from 23rd August 2019. The rate of depreciation changes. What is the change in the rate of depreciation? Motor buses or lorries or taxis running on hire acquired between 23rd August 2019 and 31st March 2020 and put to use on or before 31st March 2020, the rate of depreciation now is 45%. So if you are purchasing vehicles on hire between 23rd August 2019 and 31st March 2020 and putting them to use any time between these two dates, the rate of depreciation applicable would be straight away 45%. Straight away 45%. Students, please note, in income tax, the proportionate depreciation concept is not applicable. In income tax, either it's the full rate or the 50% of the full rate. It is either the normal rate or 50% of normal rate. You must be remembering the 180-day rule, which says that if you purchase an asset during the year and it is put to use for less than 180 days, then the rate of depreciation is 50% of the normal rate. But if you purchase a fixed asset during the year and put to use for more than 180 days, then the rate of depreciation is the normal rate of depreciation that is applicable. This 50% of the normal rate is not applicable for these vehicles. Please note this. Please note this. Therefore, even if you purchase a bus for running it on hire on the 31st of March 2020, then also you will get a depreciation of 45% on the bus. Understand this clearly. Understand the words that are used in the law clearly. You will still get 45% as deduction or for depreciation from the value of the bus. In these two cases where they have enhanced the rate of depreciation, in the first case it was 30% before, now they are saying 45%. In the second case where they are saying motor cars other than the above acquired between 23/8/19 and 31/3/2020 and put to use on or before 31/3/2020, they are saying the rate of depreciation now is 30%. This has been revised from 50%. So in the first case, the rate of depreciation was 30%. Now it is 45%. In the second case, the rate of depreciation was 15%. Now it is 30%. Okay. You ought to know a couple of things here. Number one, if you purchase these vehicles and put to use even for less than 180 days, the rate of depreciation is stuck at 45% or 30%. Okay, understand this point. Even if it is purchased on the 31st of March, the rate of depreciation is not 50%, it is 45% if you are using it on hire. If it is 30% if it is a motor car other than a car which is used on hire. Have this in mind, because depreciation problem as part of problems on PGBP, profits and gains from business or profession, are quite common for CA intermediate students, and I fear they will play a trick on this depreciation rate and ask you questions. You must be in a position to understand that the rates of depreciation have now changed. So friends, these are the amendments that I wanted to talk about, starting from the Finance Act 2019, Finance Act number 2, 2019, the Taxation Laws Ordinance of 2019, the Taxation Laws Ordinance of 2020, as also this particular circular or notification where they change the rate of depreciation in the middle of the year. In the middle of the year, once again be careful. If a bus is purchased before 23rd August 2019, then the normal rule will be applicable. The normal rule is 30% if it is put to use for less than 180 days, 50% of 30% if it is put to use for more than 180 days. Only thing is, if it is acquired on or after 23rd August 2019, then the rate of depreciation changes to 45% or 30% as is given in your screens. Okay, so these are the amendments that have taken place to the income tax law. Four different types of amendments that have taken place in the income tax law. It is always a good idea to focus on the amendments that have taken place, simply because even the examiners will have a particular sweet taste for asking questions from the amendments. So, in case you could focus more on the amendments, understand their repercussions, understand their consequences, then you would be in a better position to score marks in your income tax angle, in your income tax exams. There is one more reason why I have to concentrate more on the amendments in your income tax exam. The one more reason is that in case you do not write the November December exams, or in case you cannot clear the November December exams, I call them November December exams because I don't know exactly on which date your taxes subject falls. In case you cannot clear, or in case you decide to skip, then you have to write the May 2021 exams. For May 2021, the Finance Act applicable would be Finance Act of 2020. And in the Finance Act of 2020, more than 100 amendments have taken place. More than 100 amendments have taken place. Now look at these amendments, students. Uh, Look at this. Finance Act 2019, how many? 7 amendments. Finance Act number 2, 2019, how many? 8 here and 5 here. 13 amendments. Very easy to understand, very simple in nature. You can study them and go for the exam. But imagine a case where there are more than 100 amendments. Plus, there are a couple of ordinances where the finance minister has once again rushed to the prime minister, asked for advice, and given press releases extending dates, cutting the TDS rates, cutting the interest applicable on TDS, and so many other extensions. The whole assessment year 21-22 is going to be a big challenge. Not for a student, forget a student, even for a chartered accountant, it's going to be a big challenge. The assessment year 2021-22, because there are so many changes that have happened to income tax. Most of these changes out of compulsion rather than voluntary. Okay, it's more out of compulsion rather than voluntary. So many changes have taken place that writing the income tax and the GST exam, whether at the CA intermediate or at the CA final stage, is going to be a challenge. Okay, and for you people who are writing exams in November, December, this is going to be a golden opportunity for you to write the exams, clear it, or at least get an exemption under by scoring 60 marks and get done with it. Okay, so this is all that I wanted to speak on amendments. If there are any queries, any questions that you have, I can answer it in the last 10 minutes. Otherwise, we can call it off. I would like to extend a warm thanks to the organizers at the Trisha coaching class for giving me an opportunity to speak to you about the amendments that have taken place in direct taxes or income tax. I do hope that I have thrown light on all the amendments that have taken place. There is the revision test paper. I can just take you through. In case there are no questions, I can just take you through the RTP for the next uh, 5 minutes and call it a day. Okay, here it is, the revision test papers which have been released on the institute's website. Gives you a list of amendments that have taken place. On most of these, we have already done discussion. So they start with the changes in surcharge, and they have given you detailed examples on how these surcharge changes operate in a practical example. Please understand the different examples that they have given here, and there is every likelihood that a question will be asked asking you to calculate surcharge in different scenarios. If not in the descriptive part, at least in the objective part. So understand exactly how surcharge works. There is the surcharge slab, and there is also the restriction of surcharge on incomes on 111A and 112A to a rate of 15%. So the RTP gives an elaborate set of examples on how the surcharge works. Then they talk about the increase in the rate of depreciation from 30 to 45%, from 15 to 30%. That is also something that you have to be very mindful about, because depreciation is a thing that is usually asked at the CA intermediate level. Then they talk about the cost inflation index that is applicable to financial year 2019-20. I hope everyone knows that the CII for 1920 is 289. Some random notifications are given under section 56, which may not be relevant. You can skip that. Are given under section 56. This is one thing that I should have spoken about, but nonetheless is quite easy. There are many sections in the income tax law where they talk about payment being made in prescribed modes. Okay, payment being made by any mode other than cash, or payment being made through prescribed modes. Now, the prescribed modes definition has been expanded in the last year. I thought maybe this is not relevant at the CA intermediate stage, but the RTP mentions it, saying that the prescribed mode through which payments have to be made would now also include credit card, debit card, net banking, IMS, UPI, RTGS, NEFT, as well as through Beam app. Okay, may not be relevant at your level. Some changes in the TDS sections that are applicable: section 194N, on which we have discussed cash withdrawals. 194M, I'm not sure they have discussed here. Only 194N, I think. Yes, 194N, a lot of notifications, a lot of clarifications have come out. And right now, there's a Madras High Court judgment which is saying that 194N should not be made applicable. This is quite complicated, so there could be a chance that at the intermediate level, questions might not be asked on section 194N. 194M has also been discussed under the RTP. There are certain rules which may not be relevant, and then I think the manner of allotment of PAN and all might not be applicable, or might not be relevant. And then there are, of course, question and answers that the RTP discusses. So if time permits, there are questions. Otherwise, we can wrap this up. Okay. Okay. So I think with this we can close the session. If there are any questions, you can then ask Trisha. But if there are no questions, I'm happy that the amendments have been adequately focused on, and I hope that this would help you a great deal in writing your income tax exams for November and December. So with this, we will conclude the session, and I wish all the students watching this YouTube telecast right now all the very best for your CA intermediate exams coming up in November and December 2020. Thank you very much and wish you the best of luck.